the Bank of England was the first major central bank to blink in this global game of chicken. The Bank of England has already pivoted and has returned to quantitative easing.
In his most recent podcast, Peter Schiff talks about the emergency action by the Bank of England amid UK economic turmoil, saying it will start buying up government debt in an effort to stabilize the markets and protect pension funds. Schiff explains the impact on inflation and elaborates on the Fed's next moves with regards to raising interest rates and crashing the economy. Before listening to him, please ensure to smash the like button and subscribe to the channel. Let's dive into his last interview now.
Today was probably one of the most significant days I've seen yet in the markets. And there is an old expression, no one rings a bell. And what that expression means is that there's no warning when there's a major top or a major bottom. It's not like somebody rings a bell and tells you you've got to figure it out. Well, in my experience, sometimes they do ring a bell. In fact, oftentimes, there are many bells that are rung. The problem is people don't hear them. Or if they hear them, they don't understand them. And that also happens in bubbles, because bubbles always find a pin. But if you don't know you're in a bubble, you generally don't see the pin. And if you don't understand that there's a problem, even if there's a bell that's rung, you're likely to be dismissive because you don't get the meaning of that bell. But today, they rang the mother of all bells. In fact, it was literally Big Ben that rang, because the bell was in England, in the United Kingdom, because the Bank of England was the first major central bank to blink in this global game of chicken. The Bank of England has already pivoted and has returned to quantitative easing. Now, this is very significant because up until yesterday, the governor of the Bank of England, Andrew Daly, he was just as hawkish as Jerome Powell. He was talking tough about how resolute the Bank of England was to fighting inflation. They've got the highest inflation in Europe. It's way above their 2% target. It's a double-digit number. It's above 10%. And so Daly was committed to bringing down inflation. He even said, no matter the cost, I'm willing to endure some pain, just like Jerome Powell was saying. Well, that was all a bluff, because we got some pain overnight and Daly folded like a cheap suit, and instead of quantitative tightening, they're back to quantitative easing. The rate hikes are probably permanently on hold because the Bank of England refused to allow a potential crisis to unfold as a result of rising interest rates. And the crisis manifests itself in the UK pension system. See, the problem that pensions have had all around the world, this is not a situation isolated to the United Kingdom. So you're going to have these type of problems everywhere, including the United States. You have a lot of these defined benefit pensions where the pensions are obligated to pay out the pensioners certain amounts of money for the rest of their lives after they retire. Well, what pensions typically do is they invest a lot of money in bonds, and then they take the income from their bond portfolios and they use that income to meet their pension obligations. Well, what do you do when the central banks bring interest rates down to zero and you can barely get any income on your bonds? How do you match your liabilities with your assets when your assets are barely throwing off any income? Well, the way a lot of these British pension funds solved that problem is they took on debt. They leveraged their bonds. For example, let's say that a pension fund was typically getting a 6% yield on a longer-term British gilt. And now, because the central bank had lowered interest rates so much, the yields on those longer-term bonds had dropped to 3%. Well, maybe 3% income is not enough to meet their obligations. So what did they do? Well, short-term rates were down at 25 basis points. They were practically giving that money away. So what that enabled these bond funds to do was to go out and borrow some really cheap money and pay maybe 25 basis points on that borrowed money, and then take that money and buy a longer-term bond that yielded 3%. So let's say the pension fund now buys twice as many bonds that yield 3% as when it was buying bonds that yield 6%. It still basically gets the same yield, but it's doing it by taking on a lot of debt. It's not buying bonds with the money it has, it's buying bonds with the money it's borrowed. But of course, what they're doing is they're taking on a tremendous amount of risk, because what happens if interest rates go up? Then they're holding a bond portfolio that's collapsing in value. At the same time, the cost of servicing their short-term debt is rising, and then you get a huge problem. And that's exactly what happened in the UK. All of the pension funds that had borrowed short to buy long-term bonds were getting crushed because the value of the bonds they own was collapsing and the cost of servicing the debt was soaring, and they were in a position where they were going to get margin calls, and those margin calls were going to force an already collapsing bond market to fall even more, and that would have wreaked havoc throughout the United Kingdom. So all of these pension fund managers had a big problem, and they just substituted it with an even bigger problem, but one that wasn't going to manifest itself for the longer term. They had a situation where they couldn't meet their obligations with the income they were able to generate from their bond portfolios. So their solution was leverage. Their solution was to borrow money so they can actually earn interest on more bonds than they could afford to buy. But because interest rates were so low, the money was basically free. And so they can earn interest on bonds that they really couldn't afford to buy. Plus, because so many pension funds were actually buying more bonds than they had money, this put an artificial bid in the bond market. It was helping to artificially prop up bond prices and suppress yields, because there was more demand for bonds than there was actually savings to buy those bonds, because the central bank was creating money out of thin air and basically giving it away for free. Now, there was a better way the pension funds could have solved these problems, a more honest way, a far less risky way. They could have told the people contributing to the pensions, let's say workers, hey, interest rates are really low, so you need to contribute more money to your pensions. See, that wouldn't have gone over very well with a lot of these employees who don't want to put more money in their pensions. They need that money for themselves. They want to pay their rent. They want to buy food. They don't want to have to contribute more to the pensions. Now, the other thing that the pensions could have said is, because interest rates are so low, we're going to have to cut pension benefits because we can't earn enough money on our bond portfolios to pay what we promised, so we have to reduce what your benefits are going to be. Well, that doesn't go over very well either. Nobody wants their benefits cut, so the pension funds took the easy way out, but the very reckless way out of borrowing money. And everything was working fine until interest rates rose. And interest rates rose so much, especially in the last week, because the newly elected British Prime Minister wanted to reward all the people who voted for her by giving everybody tax cuts. So despite the fact that the United Kingdom has record inflation and record budget deficits, they decided to cut taxes and throw gasoline on a red-hot inflation fire. I pointed this out when it happened, that this was going to backfire, and it did, because the British pound started a free fall. It went to a new all-time record low. It traded below $1.04, and yield started to spike. In fact, as of yesterday, yield on 30-year British gilts was up to about 5%. And what was happening is the pension funds were getting margin calls on all the money they had borrowed. And so they were going to be forced to sell their gilts into a depressed market. That would have crashed the market. Great Britain was looking at a potential crash in the bond market, which would have sent yields soaring even more, and everything would have imploded. And so to prevent that financial crisis, the Bank of England folded. They pivoted. They decided to launch a new QE program. Remember, yesterday, they were committed to quantitative tightening. Now they said they will buy whatever it takes. They have now committed to another QE infinity in order to prop up the bond market. They now have to print British pounds to buy these gilts. And so instead of fighting inflation, which yesterday was public enemy number one. It had to be brought down at any cost. Now, all of a sudden, when you see the cost, well, forget about that. We're now going to create inflation because that is what the Bank of England is doing. They are now creating inflation. Now, they went out of their way to try to hide behind what just happened by saying, well, this is not a monetary policy decision, meaning we didn't decide to do it because we wanted to. We had to avoid a crisis. But of course, it is a monetary policy decision because that's the only policy they make is monetary policy. Deciding to launch QE is monetary policy. I don't care what you want to pretend. That's what it is. Now, the Bank of England also said that the reason they're doing it is that they just want to maintain an orderly market. Well, you can't fight inflation and maintain an orderly market because the markets have been propped up by inflation. So if you're going to fight inflation, you better be prepared for a disorderly market. And until yesterday, the Bank of England was bluffing that they were, but now that their bluff has been called, they've had to show their cards and they're holding nothing. And so inflation won. The British people now have got to accept reality that inflation is here to stay. Not just regular inflation, but extremely high inflation. It's not going to go away. The Bank of England has already made that choice. The question is, what about the other central banks? In particular, what about the Federal Reserve? Is the Federal Reserve, when confronted with the same situation, will they make a different choice than the Bank of England? Does the Federal Reserve have more integrity? Are these guys willing to allow a financial crisis? Because the same thing is going to happen here. We've got all sorts of leverage in our markets. We've got a bigger debt bubble than the British. It's just that the day of reckoning for us is not going to come as early as it did for them because the dollar is going up. It's not going down like the British pound. It's going up because America is benefiting from everybody else's problems. Even though America has bigger problems than everybody else, we're still benefiting from all the problems because the dollar is the reserve currency and the dollar is thought of as a safe haven. So when you're having problems in the UK, you buy dollars. The fact that the US has even bigger problems than you, well, that doesn't matter. The trade is there's a problem in the UK, buy dollars. There's a problem in the Eurozone, buy dollars. There's a problem in Japan, buy dollars. Yes, there's a problem all over the world. The biggest problem is in America, but nobody bothers to figure that out. They just keep on buying dollars. And so that delays our day of reckoning. But that day of reckoning is going to come. It's not permanently delayed. It's just temporarily delayed until ultimately we're confronted with the same reality that the Bank of England was confronted with today. And they made the exact choice that I would have expected them to make. And they made the exact choice that I do expect Chair Powell to make. I don't care how much he wants to bark about being tough on inflation. At the end of the day, he will not bite. The Fed is a paper tiger and it will fold just as quickly as the Bank of England when they're confronted with an actual crisis. Sure, as long as stocks are still relatively high, as long as unemployment is still low, as long as housing hasn't imploded, as long as we haven't had a major economic event, a financial crisis, maybe a big increase in unemployment, as long as the Fed can pretend everything is okay, then it can pretend it's willing to accept minimal pain in order to deal with inflation. But when it's maximum pain, then the Fed will not have the stomach for that. It's going to go back to quantitative easing, just like the Bank of England. And of course, the Bank of England is probably going to stop raising interest rates, and the Fed will do the same thing. In fact, there's already indications right now, as of today and yesterday, that there's some dissension in the ranks over at the Federal Reserve. Charles Evans was interviewed. He's the Chicago Federal Reserve president, and he implied that he now believes the Fed has moved too quickly in raising interest rates. In other words, that the Fed has raised interest rates too much too quickly, and they have to slow the pace down. Now, the reality is they haven't gone too quickly. They actually been operating at a snail's pace. They're only now trying to catch up because they got so far behind the curve, and they still haven't caught up. But now you've got Charles Evans saying, we've done too much too soon. That is the first chink in the armor there, an indication that they're going to back away from the rate hikes that they've already telegraphed. But I think more significantly, look at San Francisco Federal Reserve Bank President Mary Daly, who also said yesterday that while the Fed is resolute about bringing down high inflation, she wants to go as gently as possible so as not to drive the economy into a downturn. Excuse me, that ship has sailed. The economy is not only already in a downturn, it's already in recession, and that recession is getting worse. But what's more significant about that comment is she didn't talk about how she's willing to put the economy through pain. She wants to go gingerly. She wants to be as gentle as possible in her fight against inflation because she doesn't want the economy to go into a downturn. A downturn doesn't even mean a recession, maybe just slower growth. But the fact of the matter is, we have a massive inflation problem, and the time to go gingerly has long passed. The Fed already made a decision to let this inflation genie out of the bottle. They gambled when inflation was lower, and they gambled that it was transitory. If you remember on my podcast, I accused the Fed of betting the farm on transitory. Well, they lost the farm, and now they have to fight a lot harder. And so now they can't be gentle. They have to be tough. They have to be tougher than inflation. You can't win a fight against inflation and be gentle. You've got to knock inflation out. You got to get in the ring and kick inflation's butt. If you're just going to try to sweet talk the inflation genie back into the bottle, it ain't going to work. That inflation genie is having too much fun outside the bottle. It doesn't want to get back in. You've got to get tough. You've got to be willing to drive the economy into a downturn. If that's what it takes, you can't be gentle. This reveals that San Francisco Fed President Mary Daly really is not committed to fighting inflation. She's not as resolute as she claims. If her willingness to fight inflation ends, if that inflation fight does any serious collateral damage to the economy, because it will. Again, remember, the Bank of England was just as tough. They were just as committed and they were just as resolute until something bad happens. And what have I been saying on this podcast? We are one day away from a crisis blowing up. The same thing was true in the UK, and their crisis blew up this morning. It happened, and it's going to happen here. It's going to happen in the ECB. There are consequences to having interest rates at zero for more than a decade. One of those consequences was UK pensions being highly levered. They were trying to do what they could to make ends meet in a low interest rate environment. You know, the same thing's been happening with insurance companies. Anybody that has been dependent on interest for bonds, they've had to do something to survive in a low interest rate environment. There's a lot of bond funds that are levered up as well. In order to maintain any kind of yield, they borrow money. They take on tremendous risk. That's why so many of these bond funds are falling so much, because they are levered. The only way they were able to make the interest payments was because they took on debt. The buyers of these products had no idea how much risk the underlying funds were taking. They thought they were buying something safe. Something is safe, but not if you lever it up. The minute you take on a lot of debt, it's not safe at all. So there's all sorts of malinvestments and risk-taking. In fact, one way a lot of people dealt with low yields on bonds is they bought more stocks. They gambled on the stock market going up because they couldn't get enough of return clipping the coupons on their bonds. So they figured they would buy more stocks, and those stocks would go up, and they would get that added return from stock market appreciation. Well, what if stocks go down? Not only don't you get any return, you actually lose money. So a lot of people ended up taking a lot more risk to compensate for the fact that rates were too low. These were the problems, the unintended consequences of Fed policy. They always wanted to talk about who gets helped by low interest rates. Oh, it makes it easier for people to go out and buy a home. Yes, there's always going to be a winner if you artificially lower interest rates, but there has to be a loser to offset that winner. Because if somebody gets to borrow money cheap, that means somebody else is having to loan money cheap. So it's good for the borrower, it is bad for the lender. And so low interest rates were punishing lenders. And how were lenders figuring out how to get around this? Well, again, the lenders in the UK, the pension funds that were lending money and buying bonds at these low interest rates, their solution was take on leverage. And I guess they just hoped a day like this would never come, because what they did is they postponed the problem. They had a problem. They didn't have enough interest income on their bond portfolio. They could have solved the problem by being honest, telling their pensioners, we got to cut your benefits or you got to contribute more. They didn't want to do that. So they kicked the can down the road and they took on a bunch of debt and they postponed the pain until now. Of course, they're not really going to have to feel any of that pain because once again, they're getting bailed out by their central bank. So they're not actually going to get punished for their reckless risk-taking. And one of the reasons they were likely willing to take that gamble is because they were also betting that their central bank would bail them out. That was the moral hazard precedent that we set in 2008 with all the bad actors, everybody who got too leveraged up because the money was too cheap. And so they were at the debt party. Nobody, maybe other than Bear Stearns and Lehman Brothers, had to deal with the consequences of that hangover because the central banks bailed everybody out. And the message that was sent was keep dancing while the music is playing. Don't worry if it stops because the central banks got your back. Maybe had more of the central banks allowed over-leveraged banks or other speculators to go bankrupt, that would have sent a much better message. And so people would have been more careful this time because they would have learned a good lesson instead of a bad lesson.